to this earnings conversation with Mr. Amit Chadha of LTTS. We are used to the company not even putting a foot wrong. And this time around, the slight contrast that we've seen in the revenue growth versus the margin profile would lead me to start off this conversation with him by asking him about how the quarter was and what led to particularly the revenues looking slightly softer than what the Bloomberg estimates were. And then, of course, move on to the other pieces. Amit, good morning. Thanks for joining in. And a good quarter, but by the standards that you set in terms of the revenue growth that people expect of you, would you say that you yourself were a bit, if not disappointed, then not as content with the revenue performance as you would usually be?
So, Neeraj, first of all, a very happy new year.
Thank you.
To you and your viewers. Absolutely. Neeraj, if I look at it, Q3 normally is a softer quarter because of the number of working days. And this time around, actually, there were the Indian festivals, there was Thanksgiving, and there was New Year, of course, Christmas, all in the same quarter. So the number of working days was a tad bit lesser, if you ask me. And people did take vacation this time around and a lot of staycation, if you ask me. Our employees did, and that's fine because they need to recharge their batteries. So if I look at all that in that context, then 4.2% growth on constant currency is something that we've delivered, which is, we're fairly satisfied with it. In fact, 3 of our verticals came in at about 4.5 to 5% growth, and the other 2 were slightly lower than that. From a deal standpoint, we did continue the same trajectory that we have had. In fact, we had a $45 million deal win this quarter. So I do believe that fairly strong traction. Pipeline is better than what it was a quarter ago. Closures have been there, and we are still confident that we will deliver a strong 19 to 20% growth in FY22. And having said that, I also want to say that we are very confident of our $1 billion revenue run rate guidance that we had given for Q2, Q3 of FY23. So all well on that side. I just want to reassure you.
Perfect. No, and I was going to come to that, but I was just wondering if you yourself, by virtue of what you've clocked in, were not as happy. But just actually a quick follow-up before we move on to the other pieces. And deal wins was actually very good. But just one quick follow-up, Amit, would you say that this unusual piece of a lot of staycations, holidays, leaves, etc., was a Q3 phenomenon? You don't expect that to reoccur in Q4 because Omicron is certainly front and center even now in the world.
So Neeraj, I will say 2 things here. Number one, and based on the data that I have been given by our HR teams, the number of vacations that people took in this Q3 was higher than Q2, and it was higher than previous Q3s as well. I do believe there's a certain amount of fatigue setting in the people, and they need to recharge.
Of course.
And I think it's good if they do that because they come back in the new year, they come back recharged, they come back smiling, they come back strong, and that makes for a healthy base of employees as we move forward.
So it won't get repeated, you reckon? That extent won't get repeated in Q4?
It will not get repeated, and that's why we took it in the chin. And keeping that in mind, I was fairly comfortable with where we ended.
Well, happy employee is a productive employee, I reckon. Amit, actually, speaking of employees, maybe before I get to let me first finish the quarter and then we'll get to the other things. The deal wins, they look strong, 3 $10 million plus deals, including that $45 million deal that you spoke about. And if I'm not wrong, it's the 3rd deal with the same client as well, which probably shows the repeat confidence. Talk a bit about the nature of the deal wins, the logos added, and how does it look like as you move ahead in 2022?
Sure. So number one, with the client that we have won this deal, the 3rd deal with aggregate. So 3 deals, if I aggregate over the last 3 quarters, including the $45 million of this quarter, will be close to about $93-95 million, which in our business is a fairly significant number. It is for electric vehicles. We've developed our own technology around power charging, around alternators, inverters, and we are leveraging that and a lot of software stacks that we built, hardware stacks we have built for this customer. In fact, the 3rd deal allows us to set up a center in Krakow, Poland, which I've been aspiring to do for a long time. And then on the back of this deal, I'll be able to set up a Krakow, Poland center I've already taken the space, and I am confident of getting to about 300 people there in the next 3 years, right? And that opens up a new geography for LTTS to deliver from and tap into, right? One. Second, if I look at the other two deals that we have won that are 10 million plus, one of them is a plant engineering deal win. And fairly comfortable with what we've got. In fact, I believe that you will see another potential $10 million in the next quarter or so from the same customer. Again, they need time. They need to be able to get comfortable with us before they give us more. So that's that. If I was to then move on to demand opportunity, I do see a great amount of demand in the electric vehicle segment, electric autonomous connected vehicles, in digital manufacturing and digital products. I continue to see medical technologies demand being there. 5G, as you're aware, the US is now rolling out the spectrum, and two of the large companies have already started that. So there's a lot of downstream revenue that will come from there. Sustainability, people have discussed a lot of pilots. We have kicked off some very interesting pilots around zero liquid discharge, carbon capture, etc. So I believe that will also get into the mainstream in the next few quarters.
Does all of this explain why the headcount addition is 25% versus revenue growth of 18%? You front loading employees, believing that the business will pick up, or is this also a strategy that some of the IT services companies are following, which is getting a lot of freshers simply because talent is scarce and they need to tap into newer resources?
There is two things happening. Number one is that we normally used to take freshers. With the first COVID year, we did not take any freshers. We choked stuff because of the performance that we had. I think we need more freshers to right size our pyramid. So we have now, with these 1,900 freshers and the 1,100 we took in the first 2 quarters, we've taken about 3,000 freshers. We run a global training academy that allows us to be able to get these people, get them billable, productive, etc. In fact, of these 1,900 plus 11, so 3,000, about 50 people we have taken in the US, and we've been able to deploy them. So our goal going forward will be to maintain a similar fresher clip, at least for FY23. I can confirm to you, similar number of freshers will be added into the company. So I do believe it will help us from 2-3 standpoints. One, allows us to get new talent in, younger minds, right? And also helps us with the pyramid, helps us with the cost structure, helps us with attrition, retention, etc.
But attrition, I believe you said on the call, would remain at a higher, would moderate, but would remain at a higher level compared to the pre-pandemic times.
It will moderate, but in the immediate 3 quarters, right? So let's talk, so I do believe next quarter I should be better than where I was this quarter. And then it will plateau out or stabilize in that range. And I think it's another 3 or 4 quarters away when you start seeing it come down to pre-pandemic levels.
Okay. I had missed that point. So, okay. Thanks for elaborating on that. One quick word on the margins, Amit. I mean, typically companies are able to grow margins when revenues move up better than estimated. You've done really well on that front. What led to that?
So there are 2-3 things, right? One is that if I look at the verticals, we've been very clear with our verticals that we want to do profitable business. We want to do more business that's offshore related. We want to do business that's sticky. We want to grow the same account more and mine deeper. We would like to get bigger value deal size, so sales cost is lower, right? So all that, if you ask me, has come into play as we have delivered these margins. I'm fairly comfortable at this 18.x range. And knock on wood, I do believe that as I move forward, I want to be able to take money now and invest further, which we have done. So we did not choke any investments during pandemic. We actually set up 3 labs. We've set up a lab for 5G in Mysore, one in Dallas, Texas, and another in Bangalore. So we're not stepping back. In fact, we're setting up another lab for Open RAN in the 5G area in Munich, Germany. We made an announcement. We're doing it with Navineer and NVIDIA. So the investments will continue, but I do believe that this 18.x% EBIT is sustainable, and we will look to see how we can improve on this.
One last question, Amit, before we let you go, and that is on if you believe the geographical mix of revenues can change over a period of the next 3, 4, 5, 6 quarters. You are opening up a lot of smaller but critical units in different parts of the world. I hear a lot of Europe mentions out there too. Not that you were not present there any which ways. Just trying to understand if you reckon the geographical mix of Americas versus Europe versus ROW will change for you over the course of the next 4 to 6 quarters.
Let me give you a view of the next 5 years on this, rather than giving you a view of 4 quarters.
Perfect.
Our aim is that we will, so US, Europe, Japan will stay our mainstay geographies for the next 5 years. One, we've done a 5-year strat plan, so it will be there for the next 5 years. Two, I do believe that Europe will improve in terms of total percentage contribution to the company over the next 5 years. We are looking to grow that through various means, organic and inorganic. And we will focus on it and see where it goes. US, of course, I mean, I live there. A lot of our management team lives there, continues to be our bread and butter. But I do believe that Europe will improve as we move forward.
Got it. Okay. Looking forward to a year of wonderful delivery and hope it results in even better client wins for you than this quarter around or the quarter gone by. Thanks so much, John, for joining in today, Amit, and giving us your thoughts.
Neeraj, thank you so much. Stay safe. Take
Yeah,
care.
you too. And viewers, thanks for tuning in.
Bye.